So we've finally made it to chapter 13. We're at the very last section of the balance sheet, the stockholders equity section. We're going to wrap this up this time. So stockholders equity is all about, remember, those two components, stock paid in capital and retained earnings. So we're going to spend most of our time talking about that paid in capital wing, the common stock part. We'll mention the retained earnings, but we're going to spend most of our time focusing on that. But before we get to that, we need to back up and talk about what is a corporation, because well, we said at the beginning that most of what we're going to learn in here can be applied to all different types of businesses, sole proprietorships, partnerships, corporations, large and small. Specifically, the stockholders equity section is only applicable to corporations. So if you're not a corporation, you have equity, but you don't have stockholders equity because only corporations have stockholders. So let's back up and talk about the characteristics of a corporation. We talked about these a little bit in chapter 1. You've probably talked about them in other business classes that you've taken, but let's review. So some of the advantages and disadvantages of a corporation. Number one, corporations have the ability to raise money in different ways. So they have the ability of borrowing money, such as bonds, like we talked about in the last chapter, or they can issue stock. Sole proprietorships, partnerships can't issue equity. Corporations have a continuous life, meaning that ownership can change hands and legally the corporation remains the same. It's also easy to change corporate ownership, especially if you are a publicly traded corporation. So that means if you want to be an owner, all you have to do is buy a share of stock in a company. I've mentioned before that I am an owner of Disney. I own Disney stock, therefore I own Disney. Number 4 says there's no mutual agency among the stockholders. What this means is as a stockholder, you can't encumber the business. So even though I own Disney, I can't go out and take a loan out in Disney's name. The stockholders are independent of the corporation, or the corporation is independent, is separated from the owners. So we've talked about that a little bit, how the owners are considered outsiders even to the corporation. This last one is really big. Stockholders have limited liability. What this means is as a stockholder, the most you can lose is the amount that you invested. If the corporation were to go under tomorrow, file bankruptcy, collapse, everything go bad, the creditors will come after the corporation to try to get their money back, but they cannot come after you, the owner. You are limited to the amount you invested. You may never get that back, but you can't lose anything else. Whereas if you're an owner of a sole proprietorship or a partnership, even if your business is kept completely separate from your personal assets are still at risk. Now, the disadvantages, ownership is separated. We've talked about that a lot. That can certainly be a disadvantage in that just because I'm an owner, I am still considered an outsider. Earnings of the corporation are subject to double taxation. So what this means is remember the corporation files its own tax return. Disney files its own 1040. It's not actually a 1040. They use a different number, but it's essentially the same thing. So the corporation pays its own taxes. Then the corporation can choose to share some of its profits with its owners, and they do that through the form of dividends. When I, as a shareholder, receive my dividend check, I have to report it as earnings on my personal 1040, and I pay taxes on it. But remember, dividends are paid out of after-tax profit. So the corporation paid dividends on this pot of money, and then each of the shareholders are going to pay taxes again on the same pot of money. Thus the double taxation. Now, for all of the other forms of businesses, sole proprietorships, partnerships, they do not file their own tax return. As an owner of a sole proprietorship, you would attach a Schedule C to your 1040 that shows the business's profit or loss. Or if you're a partner, then you would get a Schedule K that shows your share of the partnership's profit or loss that you would attach to your 1040. But none of the other forms of business file their own tax return. If you are a corporation, specifically a publicly traded corporation, then you are subject to a lot of government regulation. We've talked about SEC requirements, audits, that sort of thing. That can be very expensive. Also, it's typically more expensive to start a corporation. There's a lot of filing fees and legal fees than it is to start a sole proprietorship or a partnership. So some terminology that we need to understand. First of all, I'm going to go a little bit out of our order. Capital stock just represents ownership. And notice this is capital with an AL, not capital with an OL like Austin and Washington, D.C. Common stock is a form of capital stock. There's also another kind of capital stock that we'll talk about in a little bit called preferred stock. So capital stock can be common stock or preferred stock, but they both represent ownership. So capital stock is kind of the umbrella term, and then there's common and preferred. Now, when a corporation when a company becomes a corporation, they file what are called articles of incorporation in a state. Businesses are incorporated in states, not by the federal government. You can choose whatever state you want to incorporate in. It doesn't matter if that's where you're headquartered or not. I will tell you that statistically speaking, more businesses are incorporated in Delaware than in any other state. The reason is because when you get sued, they have to sue you in the state you are incorporated in, and Delaware has the most favorable corporate laws. So more states are incorporated in Delaware. But anyway, they file their articles of incorporation. If those get approved, you're sent back what's called a corporate charter. Within the corporate charter, there is listed the different types of stock that you have. It's also listed how many shares you can issue. This is called the authorized stock. So this is the maximum number of shares that you may issue over the life of your corporation. So this is a really big number, like 2 bazillion or something like that, okay? A really big number. Now, when you become a corporation, your first thing you're going to do is sell some of the stock. But you're not going to sell all of the stock. You're going to start out just selling a little bit of stock. So the amount of stock that you have sold so far is the issued stock. That's the stock that has been issued, it has been sold, it is out there in the world. The authorized stock is the maximum that you can list, but issued is what you've actually issued so far. Now, what stock that is out of the corporation that is being held by stockholders is called outstanding stock. Oftentimes, issued stock and outstanding stock are the same number. So I'm authorized to issue 2 bazillion shares. Let's say I've sold 1,000. If all 1,000 are held by stockholders, then issued and outstanding are the same. There is a thing called treasury stock that we'll get to in one of the later objectives, and this is when a company issues stock, but then they buy it back for some reasons that we'll talk about later. So let's say that we are authorized 1 bazillion, or 2 bazillion, I think. We've issued 1,000, but we've bought back 100. So in that case, the issued stock would be 1,000 shares. The outstanding stock would only be 900 because only 900 of the shares of stock is actually held by stockholders. The other 100 is held in treasury stock, meaning we own our own stock. Now, as a stockholder, you can be issued what's called a stock certificate. It just represents your ownership. If you are ever on the Northwest campus, I encourage you to come by my office. I have my Disney stock certificate hanging in my office, and you're welcome to come see it. You don't automatically get a stock certificate anymore. Companies don't just print them just because you buy stock, because people are buying and selling stock all the time. But certainly if you own stock in a company, you can request a stock certificate, which is what I did for our Disney stock, and had that printed, and I have it framed, and it now hangs in my office. So I like this diagram. It just kind of shows, so authorized stock is that maximum, issued stock is what we've actually sold, and then outstanding stock is stock that is held by stockholders. So it's the issued minus any treasury stock that we have. This is a picture of a stock certificate for Smart Touch Learning. You'll notice it has the company's name on it. It would have the stockholder's name printed on it. They usually will now just give you one share of stock and then print on there how many shares of stock that you own. So we can see that Courtney Edwards owns 288 shares of stock. And then there's some other data on there. For example, the class of stock is listed up there. I realize it's hard to see in this diagram. The QSIP number, which is probably not something that you'll ever need to know. All of that's listed on there as well. This is a picture of a Green Bay Packers share of stock. So the Green Bay Packers, first of all, we're a Packers fan. Go Pack Go. But the Green Bay Packers are the only professional sports team that is actually incorporated. They are formed as a corporation, so they are truly the people's team. They are owned by people. And so if you want to own a share of Packer stock, you can. You can buy a share of Packer stock. And so this is a picture of a share of stock. I don't personally own any Green Bay Packers stock. I wish I did. I hope to buy some the next time they have an issuance, but maybe one day. Now, let's talk a little bit about the stock. So I've mentioned that there's publicly held stock. That's stock that's available for sale to just anyone on the National Stock Exchange, the NASDAQ or the New York Stock Exchange. When we think of corporations, that's typically what we think of. But the truth is that only a small percentages of corporations are actually traded on one of the stock exchanges. Most corporations in the US are what we consider to be private corporations, meaning their stock is not available for sale just to everybody. The Green Bay Packers are a private corporation. Now, every company, every corporation starts out as private. You start out as a private corporation, you issue a few shares of stock to some people. You can come back later and decide you want to sell some more stock. The Green Bay Packers did have an additional issuance, maybe 5 to 10 years ago, somewhere around there. You can come back and issue some more stock. At some point, you may decide you want to go public, and that's when you have what's called an IPO or an initial public offering. An IPO is the first time you sell your stock on one of those major stock exchanges. So we're going to be talking about public corporations here in this chapter. But again, most of what we're learning is applicable to those private corporations as well. It's just that their stock isn't sold on a stock exchange. So just like what we were talking about in the bond market, the primary market is when we sell our stock to the public for the first time. So we sell it to the public, and then the initial owners buy it, and then they can turn around and sell it to other people. And like using the term that I used in the bonds chapter, it's like selling used stock then. That does not affect the corporation, but we'll talk about that a little bit more as we go on. Now, as a stockholder, you have four basic rights, and this is referring really to those common stockholders. We'll talk about preferred stockholders in a minute. As a common stockholder, one of the basic rights that you get is a vote. For every share of stock you own, you get a vote. So the more share of stock, the more votes you get. Therefore, the more you own, the more power you have. This is why we have the basic underlined here. The basic is referring to common shareholders because preferred shareholders typically do not get a vote. Now, also, if you are a stockholder, you are entitled to dividends. Now, let me be very clear. Corporations are not required to pay dividends. There are a lot of good reasons for paying dividends. There are a lot of good reasons for not paying dividends, and we'll address those a little bit later on. What this is saying is that if the corporation pays dividends, you as a stockholder are entitled to receive a proportionate share of those, meaning they're paid on a per share basis. So the more shares you own, the more dividends that you get. But if the company doesn't pay dividends, this does not mean that you're entitled to them. The only people that can compel a company to pay dividends are the board of directors. Now, liquidation means if the company's going out of business, they're going to sell off all of their assets, they're going to use that money to pay off all of their debts. If there is any money left over after they've paid off all of their debts, then they start returning money to the shareholders. In reality, when a corporation goes out of business, there's not any money left over to pay the shareholders very often. But if there is, then shareholders will start sharing in that as it comes out. And then preemptive right. What this means is, let's say that you own a lot of stock, so you have a large voting power. Maybe you own 10% of the stock, so you own 10% of the voting power. If the company decides they're going to issue some more shares, you have essentially right of first refusal to buy additional shares to maintain your 10% voting block. You can choose to buy those shares before they go to the public, or you can say, no, I'm good, but as more shares are issued, your voting power declines. Now, I've mentioned this before. Corporations have different classes of stock. The most common type of stock is what's called common stock. But preferred stock is also available. Preferred stock gives certain advantages over common stock. Specifically, preferred stockholders will get a guaranteed amount of dividends. Now, this does not mean preferred shareholders are guaranteed to receive dividends. It just means that if dividends are declared, the preferred stockholders get a set amount, and they're going to get their amount first. And then whatever's left over will be divided among the common shareholders. So the preferred stockholders are going to get more in dividends. However, they give up their right to vote. So again, those advantages: one, they get more in dividends, but they give up their right to vote. Now, oftentimes preferred stock is given to executives as part of their compensation package. So there's a lot of research about executive compensation. We don't really have time to go into all of it, but there's a lot of theories that say, hey, if I want my CEO, my CFO, my company president, my vice presidents to really be invested in my company, I want them to be owners. I want this to be their company. Okay. I want them to be really, really invested. So I want them to give them shares of stock so that as the company does better, their stock becomes more valuable, and therefore they're getting more compensation. So really they're incentivized to work towards the betterment of the company by getting more stock, by getting a higher stock price. However, here's what you get to vote on. So we said you get a vote, but what does that mean? What do you get to vote on? As a shareholder, you really only get to vote on two or maybe three things. Every year there's what's called an annual meeting, and all the stockholders are invited to attend, and this is where the voting happens. If you can't go, you can vote by proxy. I'll confess I've never been to an annual meeting. I do hope to go one day, but Disney doesn't hold their annual meetings anywhere fun. They're always like in Arizona, some conference center. I want them to hold it at Disney World. That would be better. I would be more incentivized to go. So as a stockholder, what you get to vote on is, number one, you get to vote on who's going to be the auditors that year. Okay. If there's any major policy changes, you would get to vote on those. Those certainly don't happen every year. But the thing that you get to vote on every year is who's on the board of directors. So every company has a board of directors. Typically, they're 12 to 15 people. They are elected by the stockholders. These board of directors then represent the interest of the stockholders with upper level corporate management. So they're the ones meeting with the CEOs, the presidents, the vice presidents, those sorts of people. They have a little bit more inside knowledge. They're the ones that hire the auditors, and the auditors meet with the board of directors. So the board of directors are also the only ones who get to declare dividends. The CEO, the president, those people, they can't declare dividends. The board of directors do. So you're getting to vote on who is representing you. Just like in our local and national elections, we're voting on our representatives, our Congress people, of who's going to represent us in government. It's the same concept as to who's going to represent us in on the board of directors. So when we give the CEOs stock, if we were to just give them common stock, then they're going to get voting rights as well. Really, they're going to get to vote on who's the board of directors. The board of directors are the ones who make the decisions of the hiring and the firing of the CEOs. So essentially, they're voting on who's going to be their boss. This can be a conflict of interest. We don't want them voting on that. So oftentimes we won't give them common stock, we'll give them preferred stock. So they still get the benefits of the dividends if we're doing really well, but they won't get that vote. Now, stock may have what's called a par value, or it may be what's called no par stock. Used to, all stock had a par value, and that par value was assigned in the corporate charter. So, for example, Disney's par value is 1 cent. This means that when we issue stock, we would credit the common stock amount for the par value. Again, all stock used to have a par value because we had this concept of legal capital and it was based off of the par value. But about maybe 10, 15, 20 years ago or so, we kind of got rid of the concept of legal capital. So now stock doesn't always have a par value. If the corporation is newly incorporated, then they probably are no par stock. If it's an old corporation, like, Apple, Microsoft, Amazon, all of those companies, GE, Procter & Gamble, those all have a par value to them. Stated value stock is basically no par stock, but it has an assigned value to it. So we'll talk about what all of those mean in the upcoming objectives.